All right, welcome. This is Peter from JPCashFlow. So what you see in front of you is a strategy test that I'm doing. So what this test encompasses is we sell some puts on stocks we want to own. We wait for those to either expire worthless or they expire in the money, at which point we're going to get exercised and we have to buy the stock. And then we'll move on to option two, or the second portion of the strategy. So we're actually we're through the first portion, and here's what I did. I sold an Apple 111 to December put at 57 cents, or you multiply the times 100. So I was paid $57. So here's my options. If I'm exercised, it's going to cost me $11,000, and I'll own 100 shares of Apple. If I'm not exercised, it'll expire worthless. I'll keep the $57. We'll rinse and repeat. And then I did the same on Facebook. So if exercise, it'll cost me $11,923, and same if it expires worthless, I keep the profit and rinse and repeat. Well, option one came through on both of these. So let's just go to my platform here. And I don't know if yeah, I can. Hang on a minute. Let me pull up my statement. Let's go back 7 days from today, and we can see our cash sweep. So here you can see is where I was assigned. Okay, well, let's actually go back 30 days so you can kind of see how it started here. Okay, so here we go. If you look right here, this is me selling these. They only have about 2 days of life left to them. And basically the way a put works when you sell it is if the stock closes below the strike, then you're going to be exercised. Because basically when you sell a put, it says you are obligated to buy a stock at a strike. So there's someone on the reverse side of that transaction that bought a put, and he has the right to sell a stock at that strike. So obviously when the stock goes down, the person on the reverse side wants to sell out at a higher level than what the stock is trading at. And because I sold it, I'm obligated to buy it at a higher level. So that's what happened. So as I said in the beginning, that was fine. That's what we wanted. So you can see down here, it says exercise, stock settled. I was charged 11,100 here and 12,000 there. Now you can deduct this credit here and it makes those numbers change a bit, but we won't. For the purpose of this exercise, we'll leave it as is, and I'll show you all the math at the end. So the first part of my strategy has played out. We got exercised. We now own 100 shares of Apple, 100 shares of Facebook. Remember, with this strategy, that you're going to do this with stocks you want to own. All right, you have to be convicted in that. You have to be, and when I say that, you have to do the research to know that these are fundamentally strong companies and you want to own them. You aren't going to look back at this 2 days later and say, God, I just spent $11,000 on something I don't want, because that's when indecision plays in and you turn around losing money. We're not going to do that. So let's take a look at Apple and Facebook. So we'll look at Apple first. I paid $111. Well, today was an up day. Fantastic, right? And Apple's selling for $111.03. I could turn around and sell if I want to, but I'm not going to, because we're going to do the second part of the strategy. And then take a look at Facebook. Facebook had another good day. So after it dropped and I got assigned, Facebook has been slowly climbing back. Do I anticipate it? Not really. If you look at Facebook's chart, things are not looking good for Facebook, and I really anticipate this to keep going down. But today was an up day, so that's fantastic. So let's take a look at what I placed now. So I have two, let's see, they're there. So this is today. At the top, you can see them. I have two that are working because I placed them tonight. So they'll work tomorrow morning, and hopefully this will play out. So basically what I've done is I now sold a 114 call option on Apple and a 123 call option on Facebook. Okay. So what will happen here? Now these things have 37 days, so I'm going to have to wait a month and a week before I see what goes on. But I'll tell you how the strategy works. If either of these stocks are trading higher than the 123 or the 114, I'm going to be exercised, and I'll have to sell my shares of each one at those strike prices. So if you guys are really paying attention, you're saying, well, that's not bad because you only paid 111 for Apple and 120 for Facebook. So you're actually going to make $300 on each one. That's right. I'm going to make $300 on each one plus this credit. I was paid another 100 here and another 100 here. So let's come over here. I was going to do, so I ended up, this is how I played it out. So this one worked out. So I sold a 114, but I didn't sell it at 41 cents. I have sold it at hopefully 102. Okay. So these numbers will change a little bit. Too many decimal points there. And then on Facebook, I sold a 123. Oh, I'll change these to January. So I sold a 123, and I sold that one for 112. That's that one, and this one's here, 112. Okay. So I got to change these numbers, and I'll change those numbers. Now here's the key. If either one of these go down in price and they close below 114 and 123 respectively, they'll just expire worthless. So some people might be trying to figure this out. If you're an options trader and you're part of the Success Academy and you're watching this, you may be confused. Here's why. Remember, in the basic strategy, when you buy a call option, it gives you the right to buy a stock. The opposite is true when you sell. When you sell a call option, you are obligated to sell a stock. Why would anyone buy my stock at 114 a share if it was trading at 112 on the open market? They wouldn't. So my contract would just expire worthless. I'd keep the $112 and I'd still own the shares. That's the key important thing. I'd still own the shares. If the reverse happens and the stock ends up going up over the next month and it's trading higher than 114 and 123, I'm going to be exercised, but I'm going to be left with a decent amount of profit, more than I'm showing here. I got to redo the numbers. It's actually more. Now, I want to give you a couple caveats to this strategy. It looks great on paper. Actually, it doesn't look great on paper because if you look at it, my return on investment, this one, when I originally calculated, was 3.5%, and this was just over 4%. Those numbers will go up a little. I think this one will be over 4%, and this one probably close to 5%. And those seem like great things. But you have to remember, I am risking how much money? $22,000. That's what I'm risking right here. $23,100. Because that's what I paid for these. Okay. Now there are some, remember, these are stocks I want to own. So I don't think they're going to go to zero. I don't think Facebook and Apple are going to go out of business in a month and a half. Okay. It's possible. Anything could happen. The world could come to an end in a month and a half. I think the least of my worries would be Apple and Facebook stock and $23,000 if the world was mass chaos in a month and a half. But the reality is it probably won't happen. I'm expecting that both these stocks, looking at the charts, will probably continue to go down over the next month and will be good. So that's it. That's the second part of this strategy. I kind of culminated it into one video, so you guys can see what I'm doing. I will follow up, obviously. I may or may not do follow-ups leading up to the expiration. I may just wait until January to do the next video, so you unfortunately have to wait a month and a half. But you'll get to see the strategy. But again, remember, it's a strategy that I risked $23,000 to do. So it looks like, you know, everything can work out nicely and I can make some decent money. But just understand you're risking $23,000 in which to do it. There's easier strategies. But I wanted to try it out. I wanted to see how it worked. And these are actually, with the exception of Facebook, these are actually Apple's a stock I do want to own in the future. So, all right. So that's it. I will see you guys in the next video. You take care.